Global Finance, Topic 15, Global Capital Budgeting, Country Risk, copyright Lou Gaddis. For this section, there's also an angel quiz set up to give you participation points, already loaded in Angel. So go ahead and take a look at it. It says Topic 15 poll questions, and that has to be completed by Monday. So in this topic, we'll look at how to value farm projects and mitigate country risk. So we'll start with a little review problem. So this problem actually is one of the poll questions in Angel. And in this question is really just a domestic capital budgeting problem. Caterpillar is looking to invest $100 million in Indiana, not India, Indiana, and expects 3 years of cash flows of the following. And you're given the Caterpillar's tax rate and beta, risk-free rate, market risk premium, debt spread, and so on. And they also want to value the investment that the total value of the investment is worth 5 times free cash flows in year 4. So we're going to do an NPV for 4 years. And so in this type of problem, we would first calculate the cost of capital, which you first need the cost of equity using CAPM. So we're going to use CAPM, risk-free rate, plus Caterpillar's beta, times the market risk premium, and we get a cost of equity of 10.5%. Then we'll calculate a cost of debt of risk-free rate plus a credit spread of 4%. So we get a cost of debt of 6%. And then we can calculate a weighted average cost of capital. Now in this problem, you're given that the D to E ratio is 0.6. So Caterpillar's D to E is 0.6. You can think of that as 0.6 to 1, a ratio of 0.6 to 1 for debt to equity. So if you were to want the D over D plus E, I would just take the 0.6 over 1 plus 0.6. That would be the ratio of debt over debt plus equity. Likewise, my E ratio would be 1 over 1.6. We'll use that in the WACC. So in my WACC, my equity percent is 1 over 1.6 times the equity rate, 10.5%, plus my D over D plus E times the after-tax cost of debt gives me a WACC of 7.91%. And now I can just calculate my NPV. I'll value the cash flows. I gave you a hint down here. The cash flows are initially $100. And then subsequent cash flows are $15. So $15 for the first year, $15 for the second year, plus $15 third year, and then the whole enterprise is worth 5 times free cash flows. So that's going to be 5 times 15 in the 4th year. So this is what we did last time. We talked about how to calculate cost of equity using CAPM, cost of debt using the weighted average cost of capital to calculate NPV. In this case, we're using a free cash flow multiple. So the question is, so to review what we talked about last time is if you're looking to do a project or an investment in the same business line using the same leverage, just use the firm's WACC. So that's what we did in this example. If you're looking to do an investment with a different leverage than the existing firm, we do something very similar to what we just did here, except we would, if we're going to use different leverage, I would have a different credit spread and a different beta and different D to E ratios. And we talked about last time how to do that. I'll relever the beta, I'll get a new credit spread, and I'll calculate the new D over D plus E ratios. So that's how we handle different capital structure. Then we said if there's actual different business, so say Apple wants to get into cable business, the cable television business, I can't use Apple's beta anymore because Apple's beta reflects electronics business. So what I'll probably use is a proxy beta. I'll actually use the beta of, say, Comcast, delevering it using Comcast's capital structure, and then relever it using Apple's proposed structure, get a new debt spread, and that's how I said you should do it. In this topic, we'll talk about, well, we can do that for foreign firms too, right? If Apple wants to get into the Mexican cable business, all they would have to do using this method is find a Mexican cable company that has a traded stock, use their beta, and then it's the same method as before. But we'll also talk about a couple other ways to do to handle foreign exchange or foreign investments. That is, we'll talk about a sovereign risk premium and then making adjustments to free cash flows. And a review, these are some of the formulas that we will use in capital budgeting. Free cash flows, which are the after-tax profits, add back depreciation, minus capex, and working capital. We said the NPV is the discounted cash flow, discounted at some rate K, the cost of capital. And if these free cash flows are free cash flows to the firm, we want to use a discount rate that captures both equity and debt discounts, or discount rates, and that'll be weighted average cost of capital. If we have to use a different capital structure than the existing firm, we'll unlever the firm's beta and then relever the firm's beta using these two formulas, plugging in the new beta into the CAPM formula. And then we'll calculate the NPV of the project. And if it's an infinite life project, we'll end the NPV either using a growth perpetuity formula or using a free cash flow multiple. Again, these will be given on the exam, so don't worry about trying to memorize these. Just make sure you know how to use them. So why is operating an investment not in Indiana, but what if I made this India? Why do it be different for Caterpillar to look for an investment in India? Well, we think that India might be riskier than the U.S. Well, I don't know that, just make an assumption right now. So why are other countries considered riskier? What is country risk or political risk? So country risk is a general term that companies use and business uses to talk about what is the risk of operating in a particular area. So items that might fall into country risk are currency risk, the risk that there's a crisis in the country and that currency rapidly devalues or maybe even appreciates. The risk of appropriation, the government seizes control of your operations. Legal risks, the risk that courts, rulings against you, effectively hurting your profitability. Trade barriers, you move into a country, then there's tariffs or quotas that hinder your ability to trade. Changes in regulation that changes your profitability. So you move into an area and then they start increasing, say, environmental regulation, and that increases costs. Changes in tax, could be changes in tax rates of both your host country where you're operating overseas, or changes in the tax rules about bringing earnings back to your home country. There's inflation risk and the associated exchange rate risk. There's the risk of an economic crisis of where you're operating that could change your sales. There's the risk of terrorism, violence, crime, and there's general infrastructure risk. The risk that you won't have reliable power to your plant. You can't, transportation, ports, airports, roads, reliable communications, reliable workforce, education system. So this is a big one when talking about operating in developing countries. A lot of companies evaluate country risk across the globe, and here's one country or company, Aon, and here's a political map they made up, and it's an interesting map, and what it shows is the blue countries are considered the safest. United States, Canada, Greenland. We've got Scandinavian countries, Norway, Sweden, Denmark. We have Great Britain, and we have much of Western and Central Europe, and Australia, and Japan, and this little sliver here is Chile. So these are considered the safest countries, and what they look at is indexes of all the things I just talked about on this last slide. Now, the riskiest places to do business would be in parts of Africa, Middle East, and parts of South America. All right, and so these are the places that probably have the biggest risks in infrastructure and crime and terrorism and expropriation risk and political uncertainty. And then other countries are just below the highest rating. So China, India, countries like Mexico, Brazil, they're considered riskier than, say, the U.S. and Northern Europe or Western Europe, but not quite as risky as others. So what do we do with this information? How do we use this concept of country risk, and how does that affect our ability or our likelihood of investing in these countries? One way of dealing with country risk is use a sovereign risk premium. So what we could do is calculate a WACC. Say if Apple wants to do an investment in the U.S., Apple can calculate their weighted average cost of capital for U.S. investments. But if Apple wants to go to Mexico, they can just take their domestic WACC, what they do for everyday investments in the U.S., and add, say, the difference between long-term interest rates for sovereign debt in the U.S. versus, say, Mexico. So say if you look at, say, 10-year bonds, and say the 10-year U.S. Treasury rate's 3%, and the 10-year Mexican rate is, say, 7% sovereign rate, you can say that the sovereign risk premium is 4%, and I'll just add 4% to any project I'm looking at in Mexico. So that's the concept of sovereign risk premium. And the idea is you're hoping that that difference between the U.S. interest rates, sovereign interest rates, and their foreign sovereign rate are somehow capturing these types of risks, and also reflecting the fact that maybe these areas here in red and orange have higher yields on their debts because of that risk. So here's a problem that's on in Angel. So Apple is launching a new venture in Brazil. The WACC for similar ventures is 8.85 for U.S., so that's their domestic WACC. The yield on Brazilian bonds is 12%, and the yield on U.S. bonds is 3%. So in this problem, simply calculate the domestic WACC plus the sovereign risk premium, which is the difference between U.S. interest rates and foreign interest rates. So if you want, you could pause now and go do that Angel quiz. You have to be concerned sometimes with using a sovereign risk premium because you're hoping that that sovereign risk premium is compensation for the risks of your business, which are maybe expropriation and currency risk and economic risk and infrastructure risk and things like that. But when you actually think about it, the people that are buying sovereign bonds, the risks they care about are default risk, inflation risk of that currency, and related exchange rate risk, and liquidity risk of holding a particular bond that might be hard to sell. So you're always concerned that the sovereign risk premium is not picking up things like infrastructure risk, right? Which might be a major concern, but that's not a concern that bondholders have. They just want to get their money back in a strong currency and easily. So to the extent that sovereign risk premiums are measuring the things that you care about, it could be a good proxy for doing business or the risk of doing business in a country. Here's an example of using a sovereign risk premium or just adjusting cash flows. So in this problem, Hershey's establishing a supply chain facility in Ghana. The project's going to cost $900 million today. And it's going to have expected cash flows of $100 million in 1 year. And then that free cash flow will grow at 2% forever. That's an infinite growth rate. Domestic WACC is 9%, and the sovereign risk premium is 3%. So in this problem, I would just calculate the NPV of the project, subtracting $900 million today, and then calculate the perpetuity of $100 million next year, growing at 2% forever, discounted at 9 plus 3%. So that's a way that we would try to capture the risk, the country risk of Ghana, by taking the most likely cash flow, and then hopefully the risks of things like expropriation are built into the sovereign risk premium. However, there is another way to do that. And the other way to do it is you keep using your domestic WACC. So we're going to discount the cash flows at, in this case, 9%. So that's going to be our K. However, what you'll do is instead of using the sovereign risk premium, go ahead and factor the cash flows for the probability of expropriation. All right, so say there's a 1/3 chance of expropriation. You can kind of think of that as a tax, right? Expropriation is 100% tax on your business. So what you could do is instead of using the 12% discount up here, to calculate the risk. Keep your domestic WACC, but instead of using 100 million as your free cash flow, reduce that by the chance that you'll get, there's a 33% chance of getting zero. In other words, a 67% chance of getting your $100. So go ahead and recalculate the NPV here. Actually, this is 990 up here, so be careful with that. Calculate your NPV here. In this case, still using your 990. You're going to spend that today. But adjust the cash flows for the 33% chance of getting zero and discount it at 9%. So it's another way of thinking about doing the capital budgeting problem, not trying to mess around with cash flows. You have better information. I'm sorry, yeah, not messing around with cash flows, doing the sovereign risk premium or adjusting cash flows. But you have to be careful not to maybe double count. I don't know if I would like to use the sovereign risk premium and factor the cash flows, because then maybe I'm double counting the risk and maybe making the project look a lot worse than it actually is. One other way you can think about using the risk of probability, the risk of default, is calculate the break-even probability of expropriation. So if you set up the NPV problem that we just did, right? And in this case, we'll add a sovereign risk premium. You could calculate, well, what is the break-even probability default that would make this project a zero NPV? Right. So I would just say, well, the NPV is minus 990 plus 100 times the probability of keeping my money, 1 minus the probability of expropriation, over K minus G. So in that case, it turns out that, if this project has less than, you think there's a less than a 30% chance of expropriation, we'll go ahead and do the project. Now, one of the last things we'll have to do as far as calculations is, how do I deal with currencies and capital budgeting? Well, that's actually a pretty straightforward problem. And anytime I would have foreign currencies in an NPV to do capital budgeting, I'll convert the currencies back to the dollar using either forward exchange rates, or I'll use IRP PPP to forecast the exchange rates. So here's an example of Bayer Material Science Division is considering an investment in Chile. The investment will cost 100,000 pesos today and is expected to return 120,000 pesos in 1 year. The WACC for the project, or the discount rate, is 15%, so I'm going to use 15%. The spot price of the peso is 450 peso per dollar. Interest rates in the US are 3%, Chile are 7%. So in this case, go ahead and calculate the NPV of this problem, converting this cash flow to dollar using the spot price, then convert this cash flow to the dollar using the forecasted exchange rate, which would be the spot price adjusted for interest rate parity. Here's US and Chilean interest rates. So get a 1 year forward rate, or 1 year expected spot price, then convert this to dollars. Then discount this second cash flow by 15%. So in review, if a company has an investment in the same business area using the same leverage, use the WACC. If it has different leverage, calculate a new WACC by relevering the beta, getting a new debt spread. And if they're in a different business or a different country, think about using a proxy beta, a sovereign risk premium, or adjusting the cash flows like we did in Ghana. So here's an example of using a proxy beta. And actually, I just stole this example from the last topic. But say Apple is looking at investment in a Mexican cable business that has different risk than Apple's existing business. In this case, I would just find a Mexican cable company's beta, unlever it, and then re-lever it for Apple's D/E ratio, and then I'd plug it into my CAPM formula to get a cost of equity. And in this case, say there's no debt, and we just want a weighted average cost of capital for, in this case, we'll just look at the cost of equity plus maybe a sovereign risk premium, and just get a discount rate that way. So again, in this example, I didn't do the full whack. I just wanted to show you an example that you could use a foreign company to get a proxy beta, re-lever it, get a cost of equity, and then maybe add a sovereign risk premium to that. In this case, we don't have the debt component to do the full whack. So lastly, we'll just talk for a minute or two about how to manage country risk for a capital budgeting exercise or a total investment. So during capital budgeting, how do you deal with country risk? Well, you deal with it by making sure you apply or reflecting the risk in the NPVs by affecting either the cash flows or the discount rate to compensate for risk. For the discount rate, we're talking about using sovereign risk premiums. Cash flows, we're talking about factoring cash flows for things like expropriation. Also, when you're looking at investments, you should look at diversifying across nations and regions. If an area looks too risky currently, you could always delay the investment, wait a couple of years for the next, say, government to take place, or you can try to obtain federal insurance, for a project. Once you go into a country and you start financing the project, say raising money to start a project, you can also manage the risk by structuring the investment to minimize your firm's exposure. In other words, you can get outside financing, from the World Bank or a development bank or IMF or a foreign government or foreign bank. In that case, what you're trying to do is you're trying to reduce your exposure to that country by getting someone else to put the upfront costs, or get local partners. Get a partner, a joint venture, a licensing agreement, or do project finance. Project finance is when you borrow money and it doesn't go against the parent company. You start a project or a new venture. You borrow money in the name of that new venture, and if it goes bankrupt, you can't go back to the parent company and look for in bankruptcy court and try to address your concerns. Again, you can always minimize or delay your own investment. If you go ahead and do the capital budgeting and decide to go with the project and it starts getting risky over there, just delay. And then lastly, you want to finance foreign projects using foreign denominated debt. And the advantage is it reduces exchange rate risk because your interest expense and your revenues will be in the foreign currency. Once you've decided on the project and you've financed it, you can also manage the risk. What you can do is set your functional currency equal to the local country currency, reducing your translation exposure. You could manage your balance sheet, in other words, try to get your assets and liabilities in similar currencies. Develop local stakeholders. So one other advantage of getting a local bank to lend you money for a project, say in Brazil, is that local bank is now on your team, and they're going to be lobbying for you to succeed. Also, you have local suppliers, so if things starting to look bad, you can go back to the government and saying, hey, our suppliers are Brazilian. If you shut us down, you're going to hurt your own people. You can also do tax arbitrage, ways of trying to minimize taxes, and you can also use derivatives. So in this topic, we looked at how to deal with foreign investments in the capital budgeting process and how to mitigate country risk.